press conference on the Global Financial Stability Report. I am Randan Naggar from the IMF Communications Department. Let me start by introducing our panel. Tobias Adrian, Financial Counselor and Director of the Monetary and Capital Markets Department. Fabio Natalucci, Deputy Director of the Monetary and Capital Markets Department. Anna Elena, she's the Division Chief that oversees the Global Financial Stability Report in the Monetary and Capital Markets Department. And Evan Papagiorgio, Deputy Division Chief in the Monetary and Capital Markets Department. Tobias is going to give some opening remarks, and then we're going to take your questions. Tobias.
Good morning, ladies and gentlemen. It's a pleasure to present the new edition of the Global Financial Stability Report. Along with the report, you'll be interested in the leaflet that summarizes the report's finding. Global markets have been subjected to the twists and turns of trade tensions and have been kept off balance by continuing policy uncertainty. Against the backdrop of deteriorating business sentiment, weakening economic activity, and intensifying downside risks, many central banks have adopted an easier stance of monetary policy. About 70% of the world's economies, weighted by GDP, have done so. Investors have interpreted central bank actions as a turning point in the monetary policy cycle. The shift has been accompanied by a sharp decline in long-term yields. In some major economies, interest rates are deeply negative. Remarkably, the amount of government and corporate bonds with negative yields has increased to about 15 trillion. Moreover, markets expect about 1/5 of government bonds will have negative yields for at least 3 years. With rates staying lower for longer, financial conditions have eased, helping contain downside risks and support global growth for now. But loose financial conditions have encouraged investors to take more risks in a quest to achieve their return targets. Valuations appear stretched in some important markets, including equity and credit markets in both emerging and frontier as well as advanced economies. As a result of easier financial conditions and stretched asset valuations, vulnerabilities have continued to intensify, putting growth at risk in the medium term. Let me draw your attention in particular to our assessment of global vulnerabilities summarized in the radar chart. The gray shading in that chart shows where vulnerabilities now stand. As you can see, there has been a notable increase in vulnerabilities in the section marked Other Non-Bank Financials. Vulnerabilities among non-bank financials, which include asset managers, structured finance vehicles, and finance companies, are now elevated in 80% of economies as measured by GDP. This is similar to what we have seen at the height of the global financial crisis. The search for yield among institutional investors, such as insurance companies, asset managers, and pension funds, has led them to take on riskier and less liquid securities. These exposures may act as amplifiers to shocks. In addition, corporations are taking on more debt, and their ability to service that debt is weakening. In the event of a material economic slowdown, the prospects would be sobering. Debt owed by firms unable to cover interest expenses with earnings, which we refer to as corporate debt at risk, could rise to $19 trillion in a scenario that is just half as severe as the global financial crisis. That is, almost 40% of total corporate debt in the 8 economies that we studied, which include the United States, Japan, China, and some European countries, could be at risk in such a downside scenario. External debt is increasing in emerging markets and frontier economies as they attract capital flows from advanced economies where interest rates are lower. External debt has risen to 160% of exports on average, up from 100% in 2008. A sharp tightening of financial conditions and higher borrowing costs would make it more difficult for them to service their debts. Overall, resilience of the banking sector has improved thanks to stricter regulations and supervision since the global financial crisis. However, there are still pockets of weak institutions. Negative yields and flatter yield curves have reduced expectations about bank profitability. And the market capitalization of some banks has fallen to low levels. Among banks outside the United States, US dollar funding liquidity remains a source of vulnerability that could amplify the impact of a tightening in funding conditions and could create spillovers to countries that receive cross-border dollar loans. Policymakers need to take urgent action to mitigate financial stability risks. They should deploy and develop, as needed, new macroprudential tools for non-bank financial firms to mitigate vulnerabilities highlighted in this report. They should address corporate vulnerabilities with stricter supervisory and macroprudential oversight, including the creation of targeted stress testing of banks and the development of prudential tools for highly leveraged firms, which can help restrain debt at risk. They should tackle risks among institutional investors through strengthened oversight and disclosures. Emerging and frontier economies should implement prudent sovereign debt management practices and frameworks. Greater multilateral cooperation is needed in several areas. Policymakers should complete and implement the global regulatory reform agenda. They should ensure there's no rollback of regulatory reforms. In addition, policymakers should foster the further development of sustainable finance, an approach to investment that takes environmental, social, and governance factors into account. To help promote awareness of climate threats and other risks to the financial system, policymakers should encourage better corporate disclosures and adequate standardization. To sum up, with financial conditions still easy and with vulnerabilities building, policymakers should act now to reduce the vulnerabilities that could exacerbate the next economic downturn.
Thank you, Tobias. We're ready to take your questions now. Please.
Hi, Heather Scott with AFP. Can you be a little bit more specific on what types of debt that you see as most concerning? I mean, in the 2008 financial crisis, it was subprime loans that started everything. What areas are you looking at? And also, can you be more specific on what you would recommend policymakers do? How do they address, I mean, they've taken steps to shore up the banking system. So what other steps do they need to take more specifically? What can they do to address these non-bank problems?
Absolutely. So the banking system is safer today. There's more capital and more liquidity in the banking system, and stress tests are commonly done across jurisdictions. At the same time, vulnerabilities in the non-bank financial sector are building, so there's a growth of credit intermediation in the non-bank financial sector, and corporate vulnerabilities are rising. So what we urge policymakers to do is to contain underwriting standards for those non-financial corporations at the issuance stage. This could be done via a number of policy tools.
Yeah, so just let me elaborate a little bit on what can be done to contain corporate sector vulnerabilities. But first, just to step back and maybe comment a bit on the 19 trillion US dollar number. So this is our estimate of debt at risk which we define as debt owed by non-financial firms with weak debt repayment capacity. That is, that don't have enough earnings to cover interest payments. That's not necessarily debt that will default immediately, but these are firms that would be at risk of distress in a significant material economic slowdown. And so the estimate that we provide in the report is for 8 major economies, including United States, China, Japan, and several European economies, in a material downturn, which is about half of the severity of the global financial crisis. So the reason why this number is large, and the number is indeed large, is because of, I would say, 3 things. I would highlight 3 things. So first, corporate debt levels have increased in major economies over the last decade significantly. Total corporate sector debt in these 8 major economies now stands at about $51 trillion US, and that compares to about 34 trillion in 2009. So this is a significant increase. Second, corporate vulnerabilities are already elevated in a number of major economies. In some of them, debt at risk is already at about 25% of total corporate debt. And of course, in an adverse scenario, it rises fast and further. And what is particularly notable is that even though the shock is only half the severity of the global financial crisis, in many of these countries, debt at risk rises to the same level as we've seen during the financial crisis, or even exceeds those levels. So that tells us that there are quite a few weak non-financial firms in these economies that are still able to roll over debt and continue to accumulate debt because of very low interest rates. But of course, you know, the concern is that in an economic downturn, these firms may come under pressure, and they may experience difficulty servicing the debt and may have to deleverage. So when they deleverage, they cut back on investment, employment, and that exacerbates the recession. What we've seen during the euro area crisis. So just to answer your question on what can be done, as Tobias already mentioned, it should be done through a combination of more stringent supervision, particularly of credit assessment practices and lending practices of banks, which is what supervisors presumably already do. But, you know, perhaps there are some areas where more attention is needed, like in regional banks that are more exposed to small and medium-sized firms. And if corporate debt is viewed as reaching systemic levels, then macroprudential tools can be activated as well, including sectoral tools, such as additional risk weights or additional capital buffers on bank exposures to corporates. If the main source of credit is not banks, but rather non-bank financial intermediaries, and this is somewhat more complicated because there are fewer tools policy tools to address that. But again, you know, more rigorous supervision is needed, more disclosure perhaps by these financial intermediaries to allow more comprehensive assessment of risks by both investors as well as supervisors. Of course, I mean, there are other tools that could be considered as well. For example, some criteria on credit quality of securities that different financial intermediaries can invest in, and so on and so forth. So let me stop here.
Thank you, Anna. The gentleman in the room. 2. One after the other, possibly.
Larry Elliott of The Guardian. What you've outlined seems very familiar to those of us who've been here for quite a long time. Lots of risk, lots of debt, lots of vulnerability, and a lack of policy action. How close do you think we are to repeating the mistakes of 2008 when action was taken, but taken too late and only after the problem had exploded?
Thanks for the question. We are in a better place today from the point of view of banking regulations. Banks have more capital. There has been tremendous progress in terms of banking regulation and to some extent insurance regulation as well. So I do think that we have to acknowledge that overall capital and liquidity levels in the banking sector are much better, and the banks remain the core of the financial system. So, you know, some estimates are that, depending on the country, high-quality capital is about 2 to 3 times higher than it was prior to the last financial crisis. So tremendous progress has been made there. But we do see a buildup of vulnerabilities in the non-bank financial sector and in the corporate sector in particular, as Anna has explained. And we worry particularly about the risks in the medium term. In the short run, say over the next year or so, risks have been contained to some extent by the sharp easing of monetary policy that has occurred in many countries around the world. So that easing of monetary policy has taken out some of the downside risks, but in the medium term, say over 2 to 3 years, we worry that vulnerabilities continue to build up. And in a scenario of adverse shocks, these vulnerabilities are amplification mechanisms that can make shocks worse. So financial vulnerabilities act as amplifier for any negative shocks. And so we do worry about the medium term, and we urge policymakers to take action today using prudential policy tools to contain the deterioration of underwriting standards, to make sure that the non-bank financial system is safe and that underwriting standards in the corporate sector don't deteriorate too much.
I'll take the gentleman here first, and then we go back.
Good morning. How the trade wars, they would increase those vulnerabilities and would it, put the risk, the financial risk worldwide?
Yeah, the question was about trade tensions. So what we have seen over the past year, really over the past 2 years, is that trade tensions have moved markets. And many times when the markets became more pessimistic about trade, there have been significant moves. And downside risks to economic activity have been a function of those trade tensions. So we urge policymakers around the world to continue to work together in order to resolve those trade tensions, as that is a significant source of uncertainty and a significant source of creation of downside risk is the trade uncertainty. Now, the trade uncertainty is interacting with the financial vulnerabilities. So financial vulnerabilities are amplification mechanisms for bad news. So when there's bad news on the trade front, then the higher the financial vulnerability, the worse the amplification. That's our thinking about financial stability. And as we pointed out, these vulnerabilities are rising, particularly in the corporate and the non-bank financial sectors.
The gentleman, I'm sorry.
No, sorry. I just wanted to make a very quick point. Thank you. In terms of the implications of trade tensions are obviously very important on the real economy and obviously on trade. But as Tobias also mentioned, there are real implications for portfolio flows in particular to emerging markets. Clearly, we are very concerned about, the whole world is very concerned about China and the US, but there's also real spillovers to emerging markets. We have seen that equity flows in particular to emerging markets have reacted very closely to the ebbs and flows of those trade news, and there seems to be a dominant factor from the external, dominant effect from the external factors on those portfolio flows rather than country-specific fundamentals. And we think that's very important because much like you've had strong inflows during periods of calm, during calm periods, you can have sudden reversals of those flows.
Thank you. The gentleman here on the right, and then I'll shift to the other side.
Yes, Alex Brummer, Daily Mail, London. Yesterday we saw rather a spectacular explosion of an open-ended fund empire in the UK, the Woodford funds. I just wondered what you thought about the vulnerabilities of open-ended funds and what steps should be taken by regulators to try and address that vulnerability.
So we have one chapter in the financial stability report that focuses on the behavior of institutional investors in this lower for longer environment. So the three investor types we focus are asset management, pension funds, and insurance company. So the open-ended funds is one subset of the asset management industry. What we highlight there is that in this low for longer environment, there is an incentive for some of these players to reach out for yield in the form of more illiquid securities, higher credit risk, to achieve their return targets, whether they have nominal mandates or whether because they have nominal return targets or because investment mandates. So the two risks we highlight there are that liquidity buffer, some of these funds have decreased, and also that the portfolio seems to be much more correlated, much more similar. And so the reason why we highlight those is that those could become issues of financial stability concern in some sense, right? On one hand, because those are the marginal bid for some of these assets, especially credit, and so they are pushing down higher valuation for credit. And so if that demand comes away, it could have repercussion for asset valuation, but also because those could be amplifiers in the sense that if these funds come under pressure, specifically those that they provided daily liquidity and invest in more illiquid assets, that once they run through the buffer, whether that buffer is cash, liquid assets, or lines of credit with banks, they might be forced to sell, and that could generate a fire sale that would be an amplification of mechanisms. And in fact, there's a box where we provide a stress test scenario where we look at what would happen in terms of these funds if there are, in fact, demand for withdrawal and liquidity, and the number in terms of shortfall, it's about 160 billion, which is about 1.5 of assets, 1.5% of the assets of the fund under this scenario. The weakness seems to be concentrated geographically more in Europe than other jurisdictions, and also more among the smaller fund than the larger fund. So the point in all this is, in some sense, those are, as Tobias mentioned, as amplifier. If there are shock and you go to a fire sale episode, that could in fact amplify the price moves. And so the recommendation, what the recommendation they were up there, so enhanced supervision and disclosure. Specifically for the funds, a couple examples of measures that could be considered are, one, considering very strict liquidity risk management, and as well as stress testing, as well as stepping up efforts to address leverage and maturity and other liquidity mismatch in the funds.
We'll go to the gentleman here, and then we return.
Thank you. Simon Ateba, Today News, Africa, Washington, D.C. The Trump administration has been warning against Chinese debt in Africa. Do you see any risk? Can you talk generally about Africa and China in Africa, especially China loans? Thank you.
Yeah, thank you. The issue of non-Paris Club creditors, we have looked into it in this Global Financial Stability Report. You know, this is one of the issues that we identify as potentially creating some instability or some vulnerabilities. Not that the debt itself creates problems. We examine some issues that debt has to be used for productive purposes, but usually debt associated directly with that is given under non-Paris Club or multilateral types of agreements tends to have more idiosyncratic ways of being resolved, or may create some other issues down the line. More broadly, in a lot of low-income countries, particularly a lot of sub-Saharan African countries, the issue of debt vulnerabilities is becoming more and more prescient. There's already, as the IMF, in IMF's evaluation, there's more than a dozen countries that are either in distress or in high risk of debt distress. And you know, there the issue again of either collateralization of that debt or you know, the type of this debt may create a you know, a more difficult way of resolving it down the line through a debt restructuring, for example.
So let me just complement that by saying that, of course, capital flows to sub-Saharan Africa are something good for the country because it can be used for productive purposes. But that can also be dangerous and has to be dealt with in a responsible manner. And so when we look across countries in Africa, there's a variety of approaches. And so we do see an increase in overall debt levels, and there are both costs and benefits to that.
Okay, I'll go to the gentleman with the glasses. Yes. Second row here. Sorry.
Thank you. Good morning. I'm Fabrice Naudet-Langlois from Le Figaro, Paris. I have a follow-up question on corporate debt. If I look at the graph in the leaflet you kindly handed to us, I see that the way of corporate debt at risk in European countries as well as Japan has decreased in the past 10 years. So are these countries still a concern for you? And if yes, why? Thank you.
Yes, so the chart that you're referring to presents debt at risk as of 2009 and as of 2019 relative to GDP. So in some cases, if we look at debt at risk relative to total corporate debt, the share may be high, but if overall corporate debt is not large relative to GDP, those numbers that you see would be smaller, right? So we would worry both about the high share of firms with weak debt repayment capacity in total corporate sectors, as well as the overall size of corporate debt, because that tells us something about how debt is distributed across firms that have various fundamentals. So in the several countries in the euro area in particular, debt at risk has declined since the euro area crisis because of the deleveraging efforts that have been undertaken. And that's true that in some of these cases, even in the stress scenario, debt at risk stays below the levels that have been seen during the financial crisis. So in that sense, that would be less of a concern, yes.
Thank you.
So it's a differentiated picture. So in some countries, things have improved, in others, they have deteriorated, but the overall picture is one of concern.
The gentleman in the third row with the glasses. CCTV.
Thank you. Hi.
The mic.
Hello. Thank you. Zhao Miao from CGTN. My question is that China has made efforts on reforms to keep financial stability and like structural deleveraging, control local government debts, regulatory reforms, and international cooperations. So how do you evaluate the reforms, and what are the vulnerabilities still remains, and why? What's the reason to trigger that? Thank you.
Yeah, we welcome the efforts of the Chinese authorities to increase financial stability. As you mentioned, in a number of areas, financial regulations have been tightening, and authorities have made an effort to deleverage some parts of the financial system, including the shadow banking system. We do continue to urge authorities to continue with that path of tightening financial regulations. The shadow banking system, while it has stopped growing, it continues to be large in size. And we also have concerns for smaller and medium-sized banks and regional banks. As you know, a number of banks have failed this year. And we continue to see some vulnerabilities in that sector.
The gentleman with the blue shirt.
I would add a couple of things. In terms of vulnerabilities, the experience of the three small, medium-sized banks over the summer, in some sense, highlight three group of vulnerabilities that remain in the system. One has to do with funding, liquidity, solvency, especially small, medium banks, in terms of reliance on wholesale funding, on the liability side, investing in riskier assets on the asset side, and for some of these banks, the generally low level of capitalization as well as profitability. That's one. The second vulnerability has to do with maturity mismatch and use of leverage in the investment funds, so the shadow banking sector. So that's where the progress of deleveraging is something that we welcome. And the third one has to do with the remaining interconnectedness between the bank and non-bank sector, especially in a system that still continue to have essentially guaranteed in the system. So the point is that the trade-off here, implicit guarantees, the point is the trade-off here between, on some sense, increasing the resilience, so delivering the system, raising capital, raising liquidity, and the other hand, maintaining growth and maintaining credit growth so that that can help boost the economy. That's the balance that, in terms of intertemporal trade-off, we try to highlight in the report. And in terms of policy recommendation, the three banks' experience suggests that there's a need for a crisis management framework, including resolution for banks, as well as continue to implement the asset management reform and increasing the solvency of the banking sector, especially the small and medium size.
I'll take the gentleman in the blue shirt, then you, sir.
Hi, this is Vishwanath from India, represent Bloomberg Quinn. The question, in a previous answer to the question Anna was responding to, where you said that probably non-banking financial institutions could take higher securities because there is limited scope for some of the other tools to control their stress. But specifically in economies like India, what is coming out is that while they have been taking securities, the enforcement of the securities have been problematic, which is why the eventual recoveries of their loans have suffered considerably. And that is now turning out to be a bigger crisis within the economy. So in terms of the IMF's recommendation with respect to what could be the nature of those securities and probably some of the enforcement tools that the government could introduce.
Excuse me, the question is about market structure, or what is exactly the question on? Securities markets or? Okay. Yeah, so obviously on India, a lot of steps have already been taken in terms of NPL, for example, on the LPR recognition, and which has accelerated and helps bring things towards a resolution. I'd say the issues that are still important to us in terms of recommendations relate to more aggressive public sector bank, PSU bank, disinvestment, privatization, and in general reducing the role of the public sector on the financial system. Enhancing the bank capacity or the bank lending capacity would come on the back of that and could help reduce the fiscal contingency, if you will, from the state through the PSB banks, through the PSU banks, that is. Yeah, so that's right. That is obviously another channel of spillovers between banks and the non-banks. You also had an NBFI default this year, and a non-bank financial institution that is default this year, and a bank run on a co-op bank more recently. There, it's a matter of stricter supervision and encouraging banks to divest or to manage the risks better.
The gentleman.
Hi, Robert Schroeder with International Investor. Last time around the financial crisis, the credit rating agencies received a lot of criticism for falsely giving investors confidence in both sovereign and corporate debt that wasn't warranted. Do you see the efforts of reform were largely watered down? Does the IMF rely on those credit rating agencies at all? What's your degree of confidence in those?
That's an excellent question. So after the financial crisis, there were initial reform efforts to change the governance of credit rating agencies. But as you point out, there have been some reforms, but perhaps less than was originally envisioned. So there continue to be a number of governance issues, conflicts of interest in the credit rating agency model. Now, having said that, last time around, one of the particular challenge was that there was a whole new asset class that was being rated, which was subprime mortgages. And the historical data for subprime mortgages was limited. So models were particularly deficient. Today, what we are worrying about are corporate sector vulnerabilities. And of course, rating agencies have assessed the corporate sector for more than 100 years by now. So I would say that the models, so the analytics are probably more advanced in the corporate sector than they were in the subprime mortgage sector 10 or 15 years ago. And there's very nice work that has been done at the fund and in other agencies that is documenting those failures of the models. I mean, it's just like the models were not good for subprime mortgages. And I think we don't see that particular problem. So my answer is twofold. Yes, there continue to be certain governance problems with rating agencies. But in terms of the analytics, I think we're on a safer footing today. Having said that, of course, we do see that CLOs are an important buyer of corporate debt, and those are structured products. Now, CLOs fared well through the last crisis, which is one of the reasons why investors continue to buy CLOs, as opposed to some CDOs, say, on mortgages. But we do observe that the quality of collateral that is entering into those CLOs is deteriorating, and that is a source of concern.
I'll take one question online, and then we go back to the room. It's from El Financiero in Mexico, Leticia Hernandez. In this context that describes vulnerabilities, what is the greatest risk in Mexico, being an emerging economy linked to trade tensions between the U.S. and China, but also with high monetary policy rates?
Yeah, Mexico, obviously, Mexico has been directly in the forefront of the trade war and being concerned with the impact on global trade. So obviously, being exposed a lot to U.S. manufacturing and trade would have to, it's a very high priority for them. Our country team was recently in Mexico for the Article 4 consultation, and the recommendations that came out of that visit was pursuing a more growth-friendly and inclusive fiscal policy, easing monetary policy to the extent that inflation is in check and inflation expectations are anchored, boosting financial inclusion to strengthen the financial system, and then reinvigorating and promoting further structural reforms, particularly on state and on state-owned enterprises.
And let me just add to that Mexico is, of course, an emerging market that relies on capital inflows, and trade tensions tend to make capital flows more volatile. So Mexico, along with other emerging markets, is exposed to the volatility in capital flows related to trade tensions.
We'll go back to the room. The gentleman here.
Good morning. My name is Obin Nachima from This Day in Nigeria. Andrea, in your presentation, you highlighted the fact that external debts in emerging and frontier markets have been on the rise, which is the case we've seen in Nigeria. So will you recommend that frontier markets and Nigeria inclusive focus more on domestic borrowing instead of doing more of external borrowing? Thank you.
Both domestic and external debt markets are important for economic growth and economic development, and both markets should be well developed. But of course, any borrowing has to be managed in a responsible manner. There are both costs and benefits. So borrowing can be helpful for economic growth and investment, but it can also be dangerous when negative shocks hit. So we have done a lot of work at the fund on debt sustainability and debt management, and we have a host of recommendations of how to manage debt in a responsible manner.
Can I make a specific point on Nigeria? You mentioned local currency. Local currency borrowing could be preferred in some cases, but is not a panacea. The guiding principles, as Tobias also mentioned, is obviously prudent debt management. Over the summer, obviously, local currency flows have been more volatile, and Nigeria was not an exception to that. Nigeria has a large exposure to non-resident holders of domestic debt, particularly with central bank bills. And then, as we understand it, central bank bills, there's a lot of higher redemptions or has to deal with more rollovers of those in the coming quarters. And so managing those risks, particularly with respect to local currency debt and the behavior of non-resident investors, is very important.
We'll go to the back, the lady from the second row. I think we take this question and one more, and we have to wrap up because we have another press conference.
Yeah, thank you. I'm Zhang Qi with China's Caixin Media. And my question is about China's currency. Recently, the U.S. Treasury has designated China as currency manipulator, and they say they will conduct with IMF on this regard. I'm wondering, is there any update on this? Has the U.S. Treasury reached out to the IMF to discuss the issue? Thank you.
So the IMF has an assessment of currencies, which is the external sector report, and the Chinese currency was not viewed to be excessively valued in either way.
I'll have the lady in the third row, and then we wrap up.
My name is Hope Moses from Business Day, Nigeria. What are your recommendations on how to increase investment flows in Nigeria? Thank you.
So flows of investment to sub-Saharan Africa have been strong and expected to reach record highs this year. So global financial conditions are favorable to countries such as Nigeria at the moment. Issuing bonds in hard currency and in domestic currency is currently possible because of the favorable global financial conditions. Of course, it is key what countries such as Nigeria are doing with those borrowed funds, and as Evan was pointing out already, undertaking structural reforms to develop the economy is key.
Okay, thank you very much for coming. We will wrap up now, and there is the Fiscal Monitor press conference after that. We'll see you. Thank you for coming.